welcome to BloombergQuint. The expectation for the Asia-Pacific region and the economies and government finances is that the second half would look a little bit better. That's the expectation from Fitch ratings, so they do expect the pressure on sovereign ratings to perhaps continue. Joining us to talk us through what he makes of the evolving situation across economies and government finances is Stephen Schwartz, Head of Sovereign Ratings at Asia-Pacific at Fitch. Stephen, thank you so much for taking the time to speak with us. I am going to start with a broad question on what your current assessment of the second half of the year looks like. I know that your last published note suggested a pickup in the second half. Does that remain unchanged, given that we have seen concerns about a second wave in some countries, and in other countries like India, despite strict lockdowns, we haven't really seen the pace of infections ease off in a very material way. Are you readjusting your outlook for the second half?
Well, we're constantly readjusting the outlook, given all of the uncertainty for many of the reasons you just mentioned. But our global outlook, indeed, is for a growth pickup in the second half of the year. And here in the Asia region, we expect quarterly growth momentum after deep plunges, especially in the second quarter, to turn around as lockdown restrictions are eased and activity gradually gets back to positive momentum. So we see positive growth returning to most countries around the region in the third and fourth quarters of the year. But that will still mean large economic contractions for much of the region on a full year basis. One bright spot economically is we're growing more confident that China's economic recovery is intact. And we have a full year positive growth outlook for China at 0.7%. And in our next update, due out in just a couple of days, we're likely to nudge that up to just above 1%.
But the region, excluding China, would we see more or less all economies seeing a contraction this year? Which are the economies which have the steepest contraction penciled in from your end?
Yeah, well, India is one of the steepest contractions. We're expecting a contraction of 5% for the current fiscal year. We're also seeing contractions on a similar magnitude in Japan. Some bright spots where we might revise up our growth outlook, where we previously expected a deep contraction in Australia. They've gotten a pretty good control of the virus, and it looks like while there'll still be a full year contraction in Australia, it might not be quite as bad as we thought. We originally thought it might be over 5% for the year. There are only a handful of countries in Asia where we're expecting positive growth for the full year. I mentioned one, which is China. Vietnam is also a reasonably positive growth story. They're still benefiting from all of the foreign direct investment and trade diversion that was occurring last year. And they also have a handle on the virus by all accounts. Laos is another frontier market that we rate. They might just eke out positive growth momentum this year. And Bangladesh also looks set to record positive growth by our estimates for the year. Everywhere else, though, we're expecting contractions of varying degrees for the full year, but with some positive growth momentum returning in the second half. And I will note, though, as you flagged rightly, that these forecasts are subject to considerable uncertainty due to the evolution of the pandemic. And it's not at all encouraging in the last couple of weeks that we're seeing a resurgence of the virus in the US, pockets elsewhere. There in India, you're still really struggling to get a handle on it. And in Southeast Asia, countries like Indonesia and the Philippines are still struggling to get a control on the virus.
What about rating changes or adjustments to outlooks and ratings? We've seen the first line of sort of government stimulus or government support packages across most countries. Would you say that the rating adjustments are done for now and would now take a view on 2021 or FY 2022 in the case of India, or would they also depend on what happens in the second half of the year?
You know, we've already at Fitch Ratings had a record year for rating downgrades. We've had 31 downgrades already this year. So just in the first half of the year, we've set a new annual record for downgrades. It looks like the worst of the rating downgrades may be behind us, globally speaking. But here in Asia, we've taken a measured approach. We've got a third of our sovereign ratings on negative outlook. So the theme in our recent report, we said an economic recovery, but with lingering rating pressures. So where we've got negative outlooks, we put India on negative outlook just 10 days ago. We've got negative outlooks on countries like Malaysia, even Australia, and a handful of others. So I would say that the negative rating action is not quite yet over, depending on the evolution of the virus. But we will be assessing medium-term growth potential as this crisis gets behind us, because growth is one way some of these countries can sort of deal with their buildup in debt burdens over the medium term. A big question in our mind is, will this crisis dent medium-term growth prospects where we previously expected very high medium-term growth?
And I will come to that in the context of India. I do want to understand from you before that, though, how you are adjusting for the relative changes in economies. Just to explain my question, yes, India will see an increase of many percentage points in the debt to GDP ratio in this 1 year, but so would a lot of other economies. So how are you adjusting for the relative changes, both in growth outlook and in some of the other metrics like fiscal deficit or debt to GDP, which you all monitor more closely?
Yeah, that's a great question. You know, we tell investors that our ratings are relative rankings, and they're ordinal in that sense. And so it wouldn't be right for us to downgrade everyone. But to be honest, it's really a blend where we do keep an eye on the relative rankings. But in this environment, we could see more downgrades to come. We assess each country's credit worthiness on a standalone basis, and where we're seeing big buildup in debt ratios, especially for countries that went into this crisis with very little fiscal space relative to their rating peers. Those are the countries where downward or negative rating pressure is really building. And another ingredient in the equation, to address your question, is we really look at countries' track records in unwinding stimulus measures after crises recede. So we look back to, for example, the global financial crisis, and we saw a big buildup in debt ratios at that time, but some countries have a better track record than others in unwinding that stimulus and returning their debt trajectories to a sustainable path.
All right. Let me bring the conversation around to India in that case. It's been interesting from the outside because the three large global agencies have taken fairly differing views on India. There are the likes of the S&Ps, which are a little bit less worried or a bit more sanguine on the medium-term growth outlook. Your latest rating release, as well as of Moody's, seem to suggest that the concern is both on how quickly the debt to GDP would start to come down post this crisis and whether there has been a structural shift in potential growth, etc. Could you highlight, I know you won't be able to give me relative weightings, but I want to understand how much of this is about the current crisis in India and how much of it is what happened before and what will happen over the medium term?
Yeah, well, first, let me start on a couple of positives for India from a ratings perspective. The first is that while there was little fiscal space going into the crisis, there was some headroom with respect to the rating. Just a couple of years ago at BBB-, we were seeing some positive upward momentum in India's rating. That was because we assessed that as an emerging market, India had amongst the highest medium-term potential growth of any emerging market that we rate globally. We had assessed that it was close to 7%. Now that assumption is going to be tested, and we're going to be reevaluating to see if really India can restore growth to that potential over the medium term. The other positive for India is that it has very strong external finances compared to similarly rated peers. Its reserves at over $500 billion are very strong in terms of reserve adequacy and coverage. The sort of closed domestic nature of India's economy means it can finance its deficits domestically rather than relying on volatile portfolio flows. So those are the positives. The negatives really were twofold. One is India went into this crisis with already a very high public debt ratio, close to double the median at the triple B level. India's public debt ratio going into this crisis was already above 70%. And as you said, we're expecting it to rise by at least 15 percentage points in the coming year. So it'll really be twice the median level. And that weighs on the rating. The other factor we're looking at is the weaknesses in the financial sector. And that was one of the things holding us back really from a ratings upgrade just a couple of years ago, that together with the high public debt ratio. And what this crisis has really done is sort of expose those downside rating risks for India, which is why we refrained from an upgrade at that time and why we've affirmed India's rating at triple B minus, but with that negative outlook as we reassess the medium-term outlook and the debt trajectory.
So there's an interesting debate going on locally, and I don't even know how you separate the two. Just like you said, getting growth back is imperative not only to the debt to GDP ratio and bringing that down steadily, but also for the financial sector. A period of prolonged slow growth will only worsen financial sector conditions, and hence the argument is made that if the government needs to spend more into ensuring or aiding that growth revival, it should. But as you do that, you see debt to GDP ratios rise even further. How do you see this balance from a ratings perspective?
Yeah, another great question. You're quite right that from a macroeconomic perspective, stimulus measures are the right thing to do. There's a pressing health crisis. Businesses are closed under lockdown restrictions. Workers are being laid off. So both from a social and macroeconomic perspective, fiscal measures are the so-called right policy response, as are expansionary monetary policy. So the RBI, as an example, has been very proactive in providing adequate liquidity and trying to ease financial conditions best it can under this circumstance. However, from a ratings perspective, where we are assessing creditworthiness and the relative fiscal metrics and credit strengths against other similar countries, for a country like India that already had a high public debt ratio going into the crisis, even if it's the so-called right macro response to spend more as the crisis unfolds, it does undermine credit metrics, creditworthiness, and from a ratings perspective, leaves India weaker than it was going into the crisis. So we do recognize that some of these fiscal measures may help spur growth in the second half of the year. That's very much factored into our economic forecasts, but it does create uncertainties about the medium-term debt trajectory at the same time. So it's a double-edged sword as you think about the fiscal stimulus for countries that had little fiscal space going into a crisis like this.
Stephen, how do you judge the financing of a fiscal deficit in India or across the Asia-Pacific region? Because unlike developed market central banks, which have dumped in to buy large quantities of government debt, corporate debt in some cases, I think the response from Asian central banks has been a little bit more restrained. Is that a factor in ratings as to whether governments cross over into direct financing via central banks if required, or whether they remain restrained on ensuring this goes through the market mechanisms? How would you judge the two scenarios for developing Asian economies?
Right. I wouldn't say that the monetary response has a near-term impact on our ratings, but it is something we're going to evaluate after the crisis and over the coming years to see just how central banks are able to unwind some of these stimulus measures without generating instability in financial markets. It's really interesting that emerging markets have been this time around applying forms of quantitative easing and to various degrees have engaged in intervention in their domestic bond markets. Indonesia has gone all the way to make purchases in its primary market. That's something that we have not seen in emerging markets. And other countries such as the Philippines have been active in the secondary market in trying to stabilize bond yields. and prevent a big sell-off in the bond market. So this is increasing the balance sheets in these of these central banks, and it will create a challenge for them to unwind it in a non-inflationary way after the crisis passes, and in a way that doesn't destabilize markets. So many of these central banks are sort of taking the playbook from advanced central banks after the global financial crisis and applying quantitative easing in their own right. There is a subtle difference in what they're doing compared to developed markets. In developed markets, they're trying to keep borrowing costs low. They're keeping long-term yields low to help the public finances in this environment. Whereas in emerging markets, it's more they're trying to stabilize financial markets. So it's something that's working for the time being, but we'll have to assess the ratings impact of these measures over the medium term.
So you would judge not a move into these sort of, wartime financing measures, if I can broadly call it that, but the exit from them more?
Yeah, so we'll have to evaluate what the exit strategy is after this passes. And, it would normally be a concern, say what Indonesia is doing by purchasing bonds on the primary debt market. That's tantamount to monetary financing of the deficit. Now, as long as this is a time-bound program, its size is capped, and it's put in the context of a medium-term strategy and exit, we can kind of see through that, and we wouldn't see it as having an immediate ratings impact. But those are a lot of ifs and uncertainties, and many of these central banks are really embarking on unprecedented measures, which are called for at a time like this. But again, we'll have to assess the impact when we come out of this.
Stephen, how do you judge the extent of space, policy space available in Asia, but also specifically in India? Do you still see room on the fiscal side, but also on the monetary side for adjustments as the growth picture was?
Right. So getting back to fiscal space, it's really, once again, something, just to repeat myself, that the countries that had fiscal space going into this crisis certainly have more room for fiscal expansion. And just to give some examples, developed markets like Korea, New Zealand, Indonesia, the Philippines all went into this crisis with low public debt ratios relative to peers. So they probably do have more room. On the other hand, countries like India, Malaysia, certainly Japan at the more developed end of the perspective, had very high public debt ratios above median peer rating levels going into this, so they have less room. But we have to be careful. What do we mean by room? I'm speaking here of ratings room relative to peer medians, and what our ratings models show us in terms of fiscal outcomes, fiscal scores, downward pressure on the ratings. The question for policymakers in this environment will really be, can they finance these larger deficits without destabilizing debt markets, without undermining confidence, and what it means for medium-term exit strategies. So that's how we're thinking of the room for fiscal space. Monetary space, many countries still have some room for additional interest rate cuts. Inflation just about everywhere is really low or even negative in some countries. So that gives a bit of space to lower interest rates in this environment, especially for central banks that have built up good track records and credibility under their inflation targeting frameworks. They can probably get away with some more rate cuts. We just saw the Philippines last week cut by 50 basis points, and markets have really taken that in stride.
I have two last questions, Stephen. One is on the financial sector. I think, through your comments and through your release as well, you've reiterated the pressure on the Indian financial sector is one negative. Again, is that specific to India, and is that a longer lasting problem than just what we are seeing right now? Levels of capitalization, governance, etc. Do all of that sort of fill into the concerns you have about the Indian financial sector?
Yeah, what really concerns us about India's financial sector, sort of two factors. One is the sector going to be strong enough after the crisis to support credit flows and the investment that's required to support a return to that very strong medium-term growth that we previously thought India was capable of over the medium term? If not, that could generate tight financing conditions and hold back the strength of the recovery and ultimately medium-term growth. The second is that it does pose contingent liabilities for the government. capital injections, all of these things eventually appear on the central government's balance sheet. So that's something we take into effect in also looking at the health of the government's balance sheet.
My last question, Stephen, is on the political economy in India. There was a rare comment in your ratings release talking about the focus of the ruling government on the nationalist agenda, which may serve as a distraction from the economic reform implementation. Could you highlight what prompted that comment?
Well, I'd rather not focus on any individual pressure point on the political scene in India, but what we're referring to more broadly are the many challenges that the government faces, particularly in a crisis like this, with domestic social pressures, social tensions that come with that, some of the border conflicts, with international relations with neighbors. It's a lot to juggle at the same time. There's no sense that we don't think the government is capable of doing that, but we were simply noting that these are additional challenges on the government's plate in addition to dealing with a health and economic crisis all at the same time.
Fair enough. Stephen, I'll leave it at that. Thank you so much. It's been great to chat with you and get a deeper understanding of your perspective. Stephen Schwartz of Fitch Ratings. Thanks for watching BloombergQuint.
Thank you.